So now we want to start talking about income, where's high income earners? What is that going on? Because remember, as we've talked the last few weeks, wages at the top quartiles in terms of, the top and earners and then the second top earners have been coming down while the lowest earners have gotten better. So let's look at some of these different pieces. So many high income Americans, which is deemed as 150,000 or more, putting them in near top 10% of income distribution, are struggling to pay bills during the pandemic. 4.7% nationally, or 1.3 million people, creeps up to 9% in Philadelphia per the most recent U.S. Census Bureau Household Pulse Survey. So when you look at the many income households had difficulties paying usual expenses. So the national average, if you look at just where things are, and it shouldn't be a surprise that the cities with either the highest amount of pressure, if you will, in terms of jobs, where there's not as much, ability. If you think about Detroit losing a job at Ford, and where can you get another job? Where in Philly, New York, LA, Houston, Chicago, Boston, it's a lot of density. So like if you think about what the other thing is, they're also they're expensive cities to live in. So it's not surprising to see some of these pressure points, because they've seen all of their prices go up, from rent to food to travel to different either green initiatives or driving up pricing of natural gas or electricity. All of these pieces just make it harder and harder. So the national average was almost 4.7% of people who were deemed in the top 10% of America are struggling. And I think that is a much bigger issue when you consider, well, these are the people that, maybe fell just outside of getting some of that the government tax benefits, maybe got some, but not all. And that's when we start looking at, well, you're supposed to have savings. I'm being told there's all these savings, but why are you struggling? And I think that's where you start to get some of these problems with, well, what are the statistics? Why am I seeing all these savings? And we'll go through where some of this money is going and why it's being skewed towards that top 1%, making the number look huge, but the distribution of that number is horrendous, which again leads to even people that are deemed wealthy still struggling. So then when you take that to the next level, U.S. household net worth rose by $5.8 trillion in the second quarter to a record $141.7 trillion, large boost in part from $3.5 trillion gain in equities and $1 trillion climb in real estate. Equity share as a percent of total household assets rose to nearly 29.5%, up from 25.6% in 2019. So you have people that are buying more equities. You have people who have household net worth, which is really being driven by their gain in equities. And if you think about it, so 4.7 trillion was driven by just equities and real estate. So how many people own real estate? And how many people have the discretionary cash to buy equities or to have a 401k? And that's when you start to see this huge diverge, if you will, or a divergence in wealth, because the wealthy are getting wealthier, but the poor are just getting poorer because they're getting left behind. As they're struggling to pay rising prices, somebody can just sell a couple shares of Apple. Not to say that they will, because obviously everyone's just buying more Apple. But eventually you're going to say, well, it's time to cash out, and they'll have more discretionary cash than a large part of the population. Again, kind of skewing where this sits. One of the benefits, though, is the consumer debt service ratio has gotten much lower. And all that means is you're getting rates that have come down. Now, some of this has come back because this is from Q1 of 2021. But so essentially it's just cheaper your mortgage is cheaper, rent has come down, the rates that you can get from credit cards is a bit better. So you're getting some of that service. So even though the gross number is actually higher, it costs less to do it, which again, as that adjusts, you're going to start to see some of those additional pressure points. because the change in annualized U.S. household incomes versus February 2020, you can see most of that has been driven based on this stimmy checks. So when you look in January, you look again in March, again in April, you've had these very large checks that really essentially bridge this gap and put some of this additional into savings. But that has come out quickly when you look at food, when you look at gas, when you look at just general living expenses that have only gone up and stayed up, as we talked about in the previous segment on prices paid, prices received, this is where we continue to see those pressure points. And then the change in U.S. household wealth versus 4Q of 2019, you get an idea that it is coming from going to Q2. It's corporate equities and mutual funds. It's cash and checking saving deposits. But the biggest one is non-financial assets. Obviously, we know what that is in real estate, and corporate equities and mutual funds. Again, you're seeing that really be the driving growth, creating that separation. So, which is why when you look at household income and personal finance expectations on an aggregate, expectations of personal finance in 1 year has gotten to the lowest level it's been since essentially 2014. So you're coming back down to where we were in 2014 because you're looking at this and saying, there's a lot of pressure, there's a lot of concern, prices are going up, and then the percentage of consumers expecting household income to rise over the next year is at the lowest level. Obviously, it's above where it was during the pandemic, but you can see it's still at the lows that we've been at since 16 and 17 because so your income isn't going up, or it is going up, but it's not going to offset inflation and your costs. And that's where we continue to see some of these pressure points. And we're starting to see that balking on what people are willing to spend or pay for some of these goods. Which is then when you look at U.S. new one-family houses months of supply, you can see that supply has slowly come back, and it's now at a normal level, if you will, versus the historics as we look back over time. Now, when we go through the U.S. durable goods shipment, so durable goods shipments are now 8% above their pre-COVID level, and core capital goods shipments are 15% higher. Supply constraints weighing on supply and demand momentum, and a drag likely to continue well into 2022. Durable good orders also remain on a strong upward trajectory, up 14% relative to pre-COVID, while core capital goods orders are 19% above pre-COVID levels, a sign that demand momentum remains firm heading into 2022. Now, you have to think about the separation here because you have a massive shortfall, or we have the least amount in inventory to sales ratio ever. So that means that companies have to go out and refill their inventory. So how much of this is going to restock versus to what they see as long-term demand, near-term demand? And again, we won't know that, but for some time, but you're starting to see some of these pressure points as we talk back through some of these new Fed indicators and leading indicators. Again, this is one of those goods, one of the positives that we've seen when you look at that surprise index, but how much of that is inventory refill versus going to the end user. And then that's when we go to the U.S. durable goods. So obviously transportation strong, computers, electronics. A lot of these things are net short on the inventory side. So you're going to have a net buying just because they're trying to bridge some of that gap. We are coming into the holiday season, trying to get some inventory just to try to capture some of these additional sales. Again, these are things that are positive momentums, but have a life expectancy, especially if you see demand really start to come off, then you'll start to see the inventory start to build up. So this is just looking at it on a chart side. So durable good orders, upside surprise, 1.8% in August, with July revised up, but shipments remain constrained. Obviously, aircraft, communication, and electronic equipment higher, machine, computers, autos lower. Obviously, not surprising given machinery, computers, and autos with the chip shortage and whatnot. So again, we're just back to those pre-COVID levels, positive to see. And then when you look at non-defense capital goods, ex-aircrafts, the new orders, new shipments still coming through. Again, we have that huge shortfall, especially on the durable goods side when we look at inventories, which is going to be some of that bump. And as we've been saying over the last few months, this is one of those bright spots for GDP, because even though the consumer is 70% of GDP, about, as they slow down, that'll be a net negative. But then as companies buy to replenish inventories, that'll help offset. It's not a perfect one-to-one, but again, kind of softens some of that decline that we've been talking about as a much bigger potential. But when you look at housing. So when you think about people and their wealth and what they think they can do with their wealth, well, the purchase-only house price index for the United States, average hourly earnings of production and non-supervisory employees. So just get an idea of the huge divergence that we're seeing in terms of just where prices are and how earnings have gone nowhere near these levels. And when you go back through history, it's typically not the income that goes up to meet the prices. And that's, I think, an important thing when you're looking at where are prices right now and where are they going to be in the future. Now, they don't have to collapse back to the lows that we've seen since 2005, but you're going to have to see some of this arbitrage come down, and that'll be a mixture of new supply coming online, rates going up, and just losing that incremental buyer, which if you have less competition, obviously those prices will normalize lower. So then when we look at home price appreciation in July, top June's 19.1%. So the S&P CoreLogic Case-Shiller National Home Price Index came in at a 19.7% year over year in July, from 18.7% in June, highest on record since 1987. 10-city index at 19.1%, 20-city index at 19.9%. Cooling housing prices will likely lead to cooling inflation, but again, there's a lot of running room before we get there, because when you look at the CPI calc, it's barely even started to get a calculation. So it just gives you an idea of just how elevated everything is. So, but that's, again, leading to something bigger. Weaker existing home sales in August, minus 2% versus an estimate of minus 1.7%, and 2.2% in prior month, revised up from 2%. So share of first-time buyers declined to 29%, the lowest since 2019. Big reason was the climb in medium selling price to $356,700. This is the bulking we're talking about, where people are going to, and they're like, wait a minute, how much do you want for that house? And you're starting to see some of this balking, some of this, things going just below asking. But again, asking price is still 150% above where it was. So to come in below asking, you're still paying way more on a percentage level than last year or the year before. It's just that you're starting to see some of that slow down. And then some increase in existing home sale inventories, even though median prices ticked down from July, still up 14.9% from a year ago and the high. So you're starting to get some inventory coming through, some of that revival, and you're starting to see some calming down in the average home, which is, again, it's just you're not just essentially legging up each month. You're now kind of sitting sideways. Some things are going just above asking, just below asking. So again, you're starting to get to that tipping point. But then when we look at all regions, saw slight rolling over in the median price. West, it's essentially a pause. Northeast, slight decline. South and Midwest, also slight decline. So again, you're just starting to see things cap out. It's just we're getting to the point of slowing. And it's not that it's rolling over, because it's clearly not. It's just you're not going up anymore. And that's, again, coming to where you're going to see CPI catch up, because it's so far behind this increase that you're going to see it catch up very quickly. And then again, it's not that it's going to come down, but just stay at that elevated level. And so then August new home sales came in at 1.5% versus an estimate of 1%. And so median new home price, 20.1% year over year to $390,900. Average selling price at $443,200. Month supply at 6.1 months versus 6 months in the prior. So you saw some of that in terms of new home sales. So it's current, old, it's new homes. There's different ways to look. This one looks a bit better because people are saying, look, I mean, for anyone that's looked at homes or looks at Zillow or some of these other things for fun, the existing homes that people are asking these outrageous prices for, you're like, so do I move into it or do I blow it up? Because that looks terrible and it would have to be gutted, but yet you want going market rates, and that doesn't make any sense. So that's when you get them shifting into the new homes, which again is keeping prices elevated. You're seeing that kind of separate from where some of these other pieces are. But again, you're still starting to see some of this slowing in terms of starting to edge out. And then the fading boom in home sales selling for 1 million. So again, you just have less homes that are being sold for 1 million. Cohort's still seeing 40% growth year over year, but well down from the peak of nearly 250% versus minus 20% for homes in the 250 to 550,000 range. So $1 million homes, people are looking and saying, well, and again, there's only so many people that can buy a $1 million house. So as your incremental buyer, your cohort that you could possibly sell to, it just gets lower and lower as those individuals get taken out of the market after they purchase. So then when you look at core CapEx, is still looking strong. Cap goods, new orders, non-defense are up off the boil in year-over-year terms, but still up 15.8%, which is above pre-pandemic peak. So again, you're still seeing some of that cooling off, but you're still at a very strong level versus where we were on a historical basis. And then looking at durable good orders, stronger. So again, they're just putting into comparison in terms of where those new orders are, where the new orders on industrial, but the new orders on an aggregate level for durable goods. But then when we use the aggregate of the Fed, the regional Fed data, you're starting to see some of that softness, and there's some of that competition for what is the biggest driving force. And these are one of the things that I think, I would expect this to start to roll over, but not fall, but you're going to start to see this roll over as companies start to make up for what has happened. They start to make up for what has been missing. And as inventories start to get replenished, we see some of that slowdown accelerate. But now that but again, slowdown accelerating is very different than being negative. It's just going to be growth. It's just the growth is going to ebb and come down a bit. So now that we've gone through some of the different pieces, good and bad, we're going to turn to Europe and look at what has happened with some of their most recent economic data sets and what does it mean for the next, really the fourth quarter for the most part.